Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
If a company does not file its tax return, HMRC can legally decide how much tax it owes. A determination is a formal tax assessment issued by HMRC when a required tax return has not been filed. It allows HMRC to state how much tax they believe is due, even though the taxpayer has not submitted a return. For companies, this power mainly applies in the corporation tax system. It exists to prevent tax liabilities being delayed indefinitely simply because a return is missing. A determination is not a penalty. It is HMRC stepping in where the legal obligation to file has not been met. HMRC cannot issue a determination at will. 3 conditions must exist. A return was legally required, the statutory filing deadline has passed, and no valid return has been delivered. In the corporation tax context, this means the CT 600 is overdue. Once those conditions are met, HMRC does not need to wait for further engagement. The power to issue a determination is triggered by non-filing alone. A determination is HMRC's estimate of the tax due. It is often based on prior year results, information already held by HMRC, industry benchmarks, or protective assumptions designed to safeguard revenue. Accuracy is not the priority at this stage. The determination is intentionally cautious from HMRC's perspective. This is why determined figures are often higher than the true liability. A determination cannot be appealed in the normal way. The taxpayer cannot challenge the level of profits assumed, the tax calculation, or the basis of HMRC's estimate. The law removes appeal rights deliberately. The system is designed to force the filing of the missing return. The only way to remove a determination is to file the outstanding tax return. If a valid return is submitted within the permitted time window, the determination is automatically replaced, and the return figures become the legal tax position. This replacement is mandatory. HMRC has no discretion to refuse it if the return is valid and timely for displacement purposes. There is a strict time limit for displacing a determination. If the return is filed after that point, the determination becomes final, losses cannot be claimed, and reliefs may be permanently lost. In the corporation tax system, this is typically 12 months after the statutory filing deadline. After that, the damage cannot be undone. Determinations do not recognize trading losses, group relief, capital allowances, R&D claims, or other elective reliefs. Those reliefs only exist in law once a return is filed. No return means no valid claims. This is why determinations are particularly dangerous for loss-making or relief-heavy companies. Once a determination is issued, the tax is legally due and payable, interest runs as normal, and penalties for late filings still apply. HMRC can pursue debt collection, offset amounts against other repayments, or take enforcement action. They do not have to wait for a return. Determinations exist to protect the tax system. They prevent indefinite non-compliance, force engagement, and protect public revenue. They are not designed to be fair estimates. They are designed to be effective enforcement tools. And this brings us back to the fact we opened with. HMRC can decide how much tax a company owes, not because it wants to, but because the law allows it to step in when a return is not filed. A determination exists to enforce engagement, not to calculate tax accurately. HMRC doesn't guess your tax bill for fun. They do it because you stopped talking. This content is for general educational purposes only. Tax rules are complex and can change. Always check current HMRC guidance or take professional advice before acting.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.